This is Alex Buriak, Senior VP at Jet Lending. This short educational video is going to go over debt service coverage ratio and how do you use it when you're using it for long-term investing like rentals, vacation rentals, Airbnbs, and that kind of thing. Debt service coverage ratio, or DSCR, is the ratio between your property payment and the collected rent. Depending on the variable in which you're trying to find, we can use this simple equation of PITIA times DSCR equals rent to find your rent you need. Rent divided by PITIA equals the DSCR you'd need. Rent divided by DSCR equals the PITIA that you'd need. Payment, or PITIA, is the principal, the interest, taxes, insurance, and any association dues that you'd have on this property would be your total mortgage payment. Pay attention to association dues when you're buying condos or any homes that are in an HOA, because that can really dictate your payment if they're higher association dues. If you want to see how much debt you can accept on a property, here's a way to do it, because this can get complicated. When do you use DSCR variables to find out what your payment needs to be? Do I use it for my gross rent or my net rent? Well, let's look at both. If you use it for your gross rent, we would take $1,950 and we would divide it by the DSCR. Let's use 1.3 in this example. That would give us $1,500. If we have $1,500 and we find out that taxes, insurance, and association dues are $541, that gives us $959 P&I. If we use an approximate loan amount on a non-QM term at 30 years at 6.25%, that gives us $156,000 gross. This cash flows better. But let's look at the other way. If we take our rent at $1,950 and now we subtract the TIA, taxes, insurance, and association dues, that gives us $1,359. If we take $1,359 and divide it by the DSCR, that's 1.3. That gives us $1,083.85. If we use the same approximate loan on a non-QM term at 30 years at 6.25%, that gives us $176,000 net. We're less out of pocket on this one, but we cash flow more in the other one. Use these calculations to see how you want to acquire these properties on how you use it. As a lender at Jet Lending, we try to use the net so we can have our clients come out of pocket less. But feel free to put more into your property as you go on your down payment if you want less, if you want to cash flow better instead of being less out of pocket. So it all depends how your lender looks at it, net or gross rents when calculating this. You will find the net results are used more often, even in regional banks. How do you find what your ARV or value should be when you're buying properties? Well, let's take a 1.3 DSCR and keep it there because that's the higher of the DSCR values. Let's say the monthly rent is $2,600. Let's say the yearly taxes are $6,000. Let's say the yearly insurance is $1,500. That puts us at a 1.3 DSCR, $2,600 a month in rent, $500 in taxes, $125 in insurance. Let's calculate the expenses. $2,600 minus $500 minus $125 and minus a $50 HOA fee. The net rent is $1,925. So that means the max payment would be $1,480 for 30 years at 6.25%. You find that number by going to an amortization schedule and calculating backwards to figure out what your max payment could be per month. This puts us at a $240 loan. That means the ARV would have to be $300,000. That is the loan amount divided by 0.8, because on purchases, we are at 80% of the purchase price. The ARV needs to be at least 325 at 0.75% loan to value. So always look at your loan to values and how you're buying these properties, because it would dictate what your ARV needs to be on how you're buying them. And that's it. If you're a landlord or think you would need a lender to back you up on your business plan on your long-term options, or like a free estimate on your next rental deal, use this QR code. Give us a call, a text, an email, or chat so we get your deal closed within 3 days from clear to close from title and appraisal report back in, and have all the comfort of doing all your rental deals online. See you next time.